Welcome back to Morning Trade Live. Let's do some trading. Let's talk some tech. Tom's, you're looking at the options in Tesla. James Demmert joins us from the NYSE. He's the founder and chief investment officer at Main Street Research. Tesla having some trouble here this morning, James, and piling on because it's still stuck in a downtrend long term. What do you think?
Good morning, Oliver. I think the investors need to realize that this is a company that is maturing. It's not going to have the growth rate that it had in the past, and that's difficult for investors to grapple with. And it all is based on what we call shrinkage, at least with Tesla. They have shrinkage of market share. BYD is making a real dent in their sales. They also have shrinkage in margins. As we all know, they're trying to discount these models to increase revenue. And that shrinkage in those two areas creates shrinkage in earnings, shrinkage in revenue, and I think obviously shrinkage in the stock price. So I think investors have to really kind of recalibrate how they view a stock that's trading at 55 times earnings within that scenario.
How much do you think the stock price action is coming from a sort of opportunity cost calculus by investors who go, well, I've got Microsoft, I've got Nvidia, I've got Apple for my big cap trades, like why would I move down the spectrum of financial quality?
Well, I do think that there's something to that, Oliver. I mean, this is as you know, we think it's a new business cycle, a new tech-led bull market, AI-driven. And it's a question of choices. And there's a lot of great choices out there. And this is a company that missed last quarter. They missed this quarter. Stock doesn't act well. I think you're going to see money leaving simply because there's a better game in town. I mean, and this is that kind of market. And that's how we're looking at portfolios. We want to make sure every position in our portfolio is hitting on all cylinders and the metrics are sort of going up and to the right. This is not one of those, particularly at 55 times earnings. It's a great company. Question is it a great stock?
At this point, should it be in our Magnificent Seven? Has it lost that modifier?
Well, if we look at growth rates and valuation for most of the Mag 7 or the other 6, it makes sense. I mean, Nvidia is growing. Maybe Nvidia trades at 28 times earnings, but it's growing at close to 40% a year. Tesla doesn't have that, and so I would suggest that no, it probably should not be part of the magnificent other 6.
What do you think about all these guys who love Elon and have been Super Bowls and have talked about how great the innovation is, and now are like getting shy to pump the company because they don't like his public image? I mean, do you think that really moves this stock? There's so much obsession with like what he says in the public sphere. I mean, it seems to me like the stock's having trouble because the margins are getting more pinched.
Well, I don't think that's helping. I mean, leadership is important, and for a lot of investors, they just they don't want to own a company that management or leadership is not reflective of what they think is correct politically or otherwise, and so that's not helping. Certainly, the board is probably, as you know, putting pressure on him to maybe zip it. But that doesn't help. I do frankly think, though, that big institutional investors like ourselves, we sort of are a little bit more agnostic to that, and we're like about earnings, about valuation, about margins, and we don't want margins shrinking. We don't want market share shrinking. We want the opposite. We want it expanding. So yeah, he's creating his own problem on top of sort of gas on the fire, if you will.
Okay. We're going to look at the options market here, but we're going to talk some more tech companies in a second. Tom, how is the trading looking like right now? I mean, it's a pretty nasty sell-off because we're below $200, and that's the low from late last year.
Yeah, and then you look at, this is down over 25% so far this year. So how do you look at this? Well, implied volatility levels have fallen, even though the stock's down over 10%. So you have to take that into consideration when looking at strategies. But I looked at something that you can do on a week-over-week or month-over-month basis. If you still think the stock's going to rebound or at least consolidate here, Oliver, near these levels, around $188 a share. So I looked at selling an out-of-the-money put vertical. I went out to the February monthly cycle, so just over 3 weeks to expiration on this example. And I'm going to sell the 182.5 strike put, but I want to stay risk-defined, right? So I'm going to buy the 175 put against it, a short neutral to bullish, $7.50 wide put vertical. You're collecting roughly about 230 credit on that. So that's what you can make on this trade, but you have that cushion to the downside. Your break even about 180.20 on this one, so you've got a cushion of about 4% below the current share price in there. Now, if you do have some risk on this, just over $5 in risk per spread on it, but that probability of that 180 strike being out of the money at expiration is about 64%. So you've got good probabilities in this type of trade. And like I said, if you think this stock's going to rebound, maybe you don't want to stick your neck out and buy calls or buy call verticals. In that regard, maybe just selling an out of the money neutral to bullish put vertical might be the way to play it, because although implied volatility's come down, there's still quite a bit of extrinsic value in some of these options due to the fact that it's sliding so much today. So you can do this strategy on a, like I said, on a week-to-week or month-to-month basis if you feel comfortable that the stock's going to remain above a specific price point.
All right, so betting that the selling doesn't accelerate from here.
And even if it does, you can still be profitable all the way down to nearly $180.
All right, yeah, $8 more. Okay,
yeah.
That's some decent breathing room.
Yeah.
All right, I like that. I like that approach. I think that makes sense. That you would get a bit of support, nearby.
Yeah.
Because this is a pretty nasty one here. Yeah. If the market broadly rolls over, then Tesla's going to be in some serious trouble. Because right now it's underperforming when the market is doing so well. Now, there are some winners in our midst, James. It's a big day for IBM. I'm kind of wondering if maybe that means Intel will get some love as an old school comeback story.
Yeah, the Intel and IBM are definitely a part of the old school group. And I'm impressed, to be honest with you. IBM numbers were great. And I frankly think Intel last quarter did great. Different management, obviously, in the last few years. They're sort of cleaning that up. And I think that they're going to meet tonight after the close or exceed expectations. And we're going to be looking really careful at different parts of the report and, of course, at their commentary. I mean, this isn't a Magnificent Seven stock, Intel, but they are, sort of riding the tailwinds of AI by two different things going on, right? One is there's sort of a product cycle change from people who bought PCs during COVID, and they're sort of ready for something new. And then also the AI, people want a personal computer that possibly could chop through data like AI can. And so I think that those tailwinds are going to be really helpful for Intel here. What's going to be really important is enterprise sales. And that's what we're going to be looking for, in that report.
Okay. The hope that the hardware trough is past us, that people are going to be buying personal computers a little bit more, that some of these macro headwinds for the sector have faded. Optimistic about that?
Yeah, we are. I think in general you've got the Fed and the inflation, all that stuff is gone as far as we're concerned. You've got an economy that's robust. So now you've got the ability for companies to maybe not be so worried about their cash balance sheets and get out there and reinvest in their businesses. And Intel could be a great beneficiary of that as the enterprise says, okay, we got to put a new PC on everybody's desk. As individuals say, okay, I'm safe with my job. I got to get a new PC. I want to make sure it's AI based, and that's where Intel is going to thrive. So I think we're finally entered what Intel's been hoping for a long time: a better economic climate for their chips, and a reason that those chips people want to upgrade.
All right, nice, well said. Thanks, James, for the fundamental take. Appreciate it. Thanks for being here as always.
Pleasure.
Founder and Chief Investment Officer at Main Street Research. All right, Tom, you got a Intel trade that's more discreetly bullish than the Tesla approach.
Yeah, the option market pricing in about a plus or minus 6% move in this year. Remember, this stock, while it might be down 1% so far this year, rallied 90% in 2023 on the expectations that maybe we saw a bottoming in that PC cycle. Data centers coming back a little bit. You have to wonder what the product mix is going to be. Is AI server growth going to be stronger and kind of hurt the data center side? So this is one to watch for Intel, but it's had a nice run. So I looked at something a little bit more long term. They've got earnings after the close, but this one kind of pushes that aside and goes out in duration. So I looked all the way out in the April monthly cycle here for a bullish trade here. April 50 strike calls, just out of the money to the upside, basically at the money. Buy the 50 strike calls, but then I want to offset some of my costs because there's a lot of extrinsic value in that 50 strike call. I'll sell the 60 strike call against a bullish $10 wide call vertical to the upside, paying roughly about a 270 debit for that. That's your risk, 270 bucks per spread. But over the next 85 days, if this stock goes up to 60 or higher, that's the price of this vertical can expand to about $10. That break even of 52.70 is about 6% above the current share price in Intel. So if you think this thing's going to rally, maybe it has a hiccup here on earnings, but longer duration where you're giving yourself 3 months, this type of strategy plays out nicely. You got a good risk reward set up on it if you think this stock's going to continue to move higher and breach that 60 level.
All right. Like it. Intel seems like it's ready to go for it as we pulled back, settled into the kind of high 40s, and now we're pushing back towards the 52-week high, $51, 52-week high. So, all right, hopefully earnings go smoothly for the company. Who doesn't like to see Intel win? You know, who doesn't want to see a classic?
Well, I mean, all boats are getting lifted, right, with this high tide of tech, so why not?
For a while, theirs wasn't. Their boat was still kind of sinking. So.
Well, yeah, they were getting market share taken away from them left and right.
Okay, thanks for the trades. Into the report.